Bill. Good to see you back in Dubai.
Nice to be here.
On the road. You've got a full audience here. I've still got the pleasure of living and working in the DIFC. I can still afford it. And I walk back home every evening through the spine, and I see the DIFC hive. And I look through the windows and I go, shouldn't have been a banker, shouldn't have been a journalist, I should have been in tech. What is it that Dubai has now, because we're at a turnkey moment through those windows, what has it got now that differentiates it to the US and to the UK?
First of all, it's a real pleasure to be here. And to be a banker these days is to be a tech guy. Now, I know I don't look like a tech guy. I'm not that cool. But to be successful in banking, you've got to be at the cutting edge of technology. And I think to be a successful financial center, you've got to have the ecosystem that supports finance, obviously, but also technology. And I think what the DIFC has done is to bring sort of coherent regulation to the intersection of technology and finance. Of course, it's a competitive space. Other places around the world are also trying to bring that together. But Dubai has a wonderful history of being able to bring the insights that come from any global trend, both to make it relevant for the region, but also to re-export that globally. So I think the DIFC is in quite a good place in that regard.
You have the luxury of, luxury or challenge of being on the road constantly. But when you look at what's going on outside the region and you look inside this region, do you say that we have a human capital advantage? We're building a pod, or do we have just capital advantage in that perhaps this is a different economic moment for us here?
I think Dubai has some of both. And of course, this is becoming an increasingly attractive place for global talent to come and live and work. That's been going on for quite a while, but Dubai has demonstrated has wonderful agility and consistency in terms of developing a place that's quite a magnet for talent. It's got some other intrinsic advantages that obviously time zone, language, geography, to be at the heart of both the Gulf, but also increasingly a hub for all of Africa, is an extremely exciting place to be, and always connecting east and west, as well as north and south. So I think there's some inherent advantages here in Dubai, but of course DIFC and Dubai more broadly have made the best of the natural endowments.
So Jenny gathers the assets, you fund the growth. How big in FinTech, how much allocation to FinTech are you driving as the CEO at Standard Chartered?
We set the objective a few years back of over a 10-year period, having 50% of our income come from things that we weren't doing before. Now, some of those things will be businesses that we know about that will be fundamentally transformed through the use of technology, and others will be brand new business models. I had the great pleasure this morning of signing together with the governor of DIFC a memorandum of understanding to establish our digital asset custodian called Zodia here in the DIFC. 5 years ago, we weren't talking about a digital asset custodian in Standard Chartered Bank.
How big can that be, Bill? This is becoming a hub for crypto. It's very, very clear it's an ambition. So from an MOU to dollars, tell me what it can be.
So we have, Zodia is our digital asset custodian. And I do make the distinction between digital assets and crypto.
Okay.
So today, crypto is the bulk of what is digital assets today. When we look forward 5 or 10 years from now, I think we'll find vast swathes of the financial architecture that has been tokenized. That could include central bank digital currencies, which of course exist to some extent so far, but they're quite small at this point. Stable coins, tokenized real assets, whether it's, Jenny talks about effectively the digitization or tokenization of money market funds, right? These are trillions and trillions and trillions of dollars that could find themselves in tokenized form. And there's an underlying infrastructure that's different for distributed ledger technology relative to the current state of play. And to the extent that Dubai or anyone else can get ahead of the game and make sure that infrastructure is embedded in the local infrastructure, but also regulated from here, gives you a huge head start in terms of building that industry over time.
Well, that digitization that Jenny talked about in many ways handed the power to decide where we put our funds, which strikes terror in the heart of the average CEO banker, I would say. the SVB wrecking ball, how much tighter are you with the credit committee now globally as a result of SVB?
Well, we're not tighter at all. I mean, the results, first of all, we know where SVB started. It was with uneven regulation in the United States between these regional banks and the large banks. We're a UK bank that operates across the world. We're subject to regulation in almost every major jurisdiction. In a way, we've got the greatest of regulatory stringency. So we were a net receiver of deposits during this period of global angst. And we've got a super strong capital position and a very strong liquidity position. So we don't have to change anything. Now that said, we got to keep a very close eye on how will regulation change. I saw my old friend, Deputy Governor of the Bank of England, former Deputy Governor, Paul Tucker, I guess wrote a piece in the FT or something over the weekend saying regulation and bank management is going to have to change. We have to expect that we could have a 100% run on deposits overnight at any time. Well, that's a very different world. If we have to be prepared for that kind of migration of money, we're going to have a fundamentally different underlying functional financial infrastructure.
I mean, that sort of manages to even strike fear and horror into me. I lived through 2007, 2008 and deconstructed a business during that crisis, as did you live through it. Which brings us then to regulation. What is it? Bill Ackman says, failure to update and expand the insurance regime has hammered more nails into the coffin. So with that in mind, the FDIC is both late and lagging in regards to regulation?
Look, let's get the order of things right. First order, banks need to manage themselves properly. And when the dust settles, we all take a look at what actually happened in the US, or in Switzerland for that matter, we'll see that those banks didn't manage themselves perfectly, right? That there were things that they could have done differently that could have made this better. Second is the regulators need to have regulatory rules that incentivize good behavior and disincentivize hurtful behavior. And there were clearly some inadequacies in the regulatory infrastructure in the US and possibly elsewhere in the world. Third is the role of central banks. Now, there's been a default to, let's raise deposit guarantee thresholds. That might be a good thing to do. But if you're really worried about a massive deposit outflow from your corporate clients, from your private banking clients, your large depositors, then increasing the guarantee, even in the US, from $250,000 even to $1 million, that doesn't cover the bulk of the deposits that are sitting in the financial system. So there's a fourth piece, which is central banks. Their job is to make sure that solvent banks, otherwise healthy banks, have access to liquidity. That's what discount windows are for. I have my collateral, I give you my collateral, I get cash. And
they did a good job of that in the eye of that storm.
I'm afraid not. I'm afraid not. I mean, the fact is you had solvent banks in the US and a solvent bank in Switzerland that died because they couldn't get access to liquidity from anyone, not from their depositors and not from their central bank. And we have to ask the question, why not? That's an element of reform that I think has been overlooked so far.
What would you say in short order, and we don't have much time to solve the banking crisis of today, but what would you say is the immediate necessary response to that, if it didn't function properly?
So I think the reactive response in the US was perfect, which was to provide effectively a guarantee for access to funding for all US banks for basically all deposits. So they stemmed the crisis perfectly at that time. The ideal response, though, would have been to have provided liquidity to these challenged banks ahead of the demise. Now, they may still end up taking the bank into the FDIC, writing off the equity, imposing losses on the AT1 securities, which is this next tier of capital above equity. That may still have happened, but in a more orderly way. That wouldn't have undermined confidence in the broader system. So having liquidity facilities that are in place from the central bank to the banking community that are available against eligible collateral in advance and understood by the market. And unfortunately, it wasn't understood by the market, so there was a crisis of confidence.
And indeed, part of the assets that were pledged during this crisis were, as Jenny said, they weren't bad assets. They were treasuries. They were good, solid assets. You mentioned the change, the flow of money, the changing structure of banking. We now have JP Morgan. How big can JP Morgan really get? this is the question that goes through my mind. They took on SVB. You know, does that say to you, getting a bit too big for your boots, Jamie?
Of course not. But look, JP Morgan's deposit market share is about 12% now. In many countries around the world, the leading banks have much more than 12%, starting in the UK or the other markets where we operate, and in places like Hong Kong, Singapore. So 12% is getting toppish, but it's still a very competitive market. I think in the US, what regulators must be careful about is the concentrated deposit market share in sub-markets. So in the New York City region, in the Chicago, Los Angeles, et cetera, where you have higher concentrations. But 12% is manageable. The bigger question is that JP Morgan's just a very big bank. You know, there are other very big banks, and this whole too big to fail question comes up again and again. But as we just saw, a $250 billion bank named Silicon Valley Bank was deemed too big to fail in a conventional resolution way. So I think this whole resolution concept of what is a too big to fail bank is going to have to be reviewed.
When I started this conversation with you, I said, have you tightened up credit? Have you turned things up a little bit on the credit committee? You said, no, things are fine. I'm very happy with where we are on a credit outlook. Is there an arbitrage moment that between the West and East Coast of the United States of America and here as a geography, in that what's happening there is less likely to happen here in terms of capital must be a little bit more restrictive in the US relative to here?
Yeah, I think that the capital is available. There's no doubt about that. So we've all seen the analyses of the amount of commercial real estate related bank funding in the United States was provided by these regional banks. And it was meaningful. So you could expect that the cost of financing for those commercial real estate companies may go up. You also know that the capital markets in the United States are extraordinarily deep.
Yeah.
And the capital markets will very quickly find a way to fill that gap. So there could be a little bit of dislocation. Of course, it's at a time when there's already pressure as a result of higher interest rates on that segment and some other industrial segments. But I'm really not worried that global capital markets won't solve this problem. The fact in this part of the world is that liquidity is very, very flush. And capital is available. Economic growth is good. We only see inflows into this region, and at Standard Chartered, it's a big chunk of what we do is to facilitate and finance those inflows. So I'm very optimistic about the Gulf, and I'm not concerned about the problems in the banking sector in the U.S. or Switzerland, which is where they've been so far. I'm not really concerned about it spilling over into global economic activity.
Well, what is the consequence? Sergio Motti is back in the seat at UBS. You'd have never dreamt that Credit Suisse would quite literally fold in the space of 3 days. What is the consequence of that bill? Will there be more cross-border? Will people like you have to now actively consider, dare I say it, because I know that we're in the UAE, consider getting bigger and doing a merger, doing a deal to protect yourselves?
It's an interesting question. I think that the core of financial strength is starting with a strong capital position, a good profitable business model, and obviously always access to adequate liquidity. Now, Standard Chartered has all of that today. The second question we ask is, do we have the scale and the capacity to fund the technology investments that will allow us to continue to thrive? And every indication is yes. Right? We're growing market share in our key markets. We are at the technical cutting edge, not just in new areas like digital assets, where we're absolutely at the technical cutting edge, but in digital banking. Right? We've got the fastest growing digital bank in the world in Singapore. Now,
that's the Trust Bank business that you set up. But you also set up Mox in Hong Kong, and I suppose I heard the Apple CEO mention India 20 times in his quarterly report that I covered last week. Is that your ambition, a digital bank in India? Where is the next digital iteration for you?
Well, we are a digital bank in India, so 98% of our new accounts in India are operated through effectively a digital bank, but it's just called Standard Chartered. So we are a digital bank. We've got 9
He had me frightened there. I thought I actually hadn't read the...
What is it?
That you already are a digital bank. But how much more scale can you do and where on the digital bank side of the business?
I mean, I think there's unlimited scale. So the nature of digital banking for us is first the technology platform, which is fundamentally customer-oriented. But second, in many cases, and these are the ones that you're probably referring to, we've done with partners.
Yeah.
So in Trust Bank in Singapore, we partnered with the largest grocery store chain, who has ubiquitous coverage in Singapore. And our ability to deliver a technical solution that's completely integrated, in that case, with the reward program for this large grocery store chain with a 50% market share, means that we get access to every person in Singapore on their terms, on terms that they can understand. And as long as the app is good and the services are good and the pricing is good, all of which is the case, we get to 10% of the bankable population in 7 months. That's never happened anywhere.
The Revolut model is one to be envied. So let's talk a little bit about scale. It would be folly not to take this opportunity with you in the UAE. FAB reportedly made the 30 to 35 billion. They were thinking about it for you. If another regional lender came after you, what went through my mind before we sat down was, would your big shareholders stick with you?
Well, that's of course a question for them. Nobody's come after us, which is the good news. I mean, I've read the same stuff in the press that you have, some of which you even broadcast yourself. But the fact is, Standard Chartered Bank we have a good business model, we have good customers, we've got good profitability, we're growing nicely, we've got super strong capital, good liquidity. We have all the capacity and resources we need to keep on growing and living an independent life. If somebody wants to come in and talk to us about how they can make us better or how we would be better in there, be my guest, right? You can always have a conversation. We have that responsibility to our shareholders. But I'm very, very confident that we can deliver this package all by ourselves.
I mean, I caught up with Noel Quinn the other day, and he said these two are doing like a joint roadshow in Hong Kong in the next couple of weeks. And I said, "Is this the first big date? Are you going to put a ring on one another's fingers?" Noel laughed, but the more important question is: do you think your biggest shareholders do they want to see the same thing with you? Do they want to break you up? You're domiciled in the UK, but you are a trade bank for Asia and India and Africa.
We are. Look, our biggest shareholders, one of which is Jenny's company, want us to succeed, right? They want to see our share price go up, and they want to see a long-term, enduring creator of value. That's our ambition. We think we're on the right track to deliver all of that. The idea of dating Noel Quinn is absolutely horrific, so I'd prefer that you not leave that image in my mind. No, I mean, there's lots of people I'd like to date before Noel, but we are in fact hosting a group of international shareholders and analysts in Hong Kong and Singapore. For the simple reason that we think that much of the world doesn't really understand just how exciting Asia is right now. Mm-hmm. Interestingly, I think people do understand how exciting the Middle East is. Yeah. I think you probably...
It's changing.
You've got maybe some better PR. Or also, you struck a much more neutral tone in terms of the geopolitical conflicts, which means that people can see the real growth and opportunity in the Middle East. But if you're sitting in the US or Europe right now, I'm afraid that it's hard to imagine just how exciting Asia is. And Noel and I together think that we can bring a group of investors out to Asia and just expose them to that excitement. And a very, very core part of that is the connection between the Asia nexus and the Middle East. Capital is going both ways, talent is going both ways, commercial flows are going both ways. This is an extremely important corridor. And I can assure you, when Noel and I and our colleagues are speaking together next week with shareholders, a lot of the discussion in the context of China and the context of Singapore, Hong Kong, will be back to the UAE and Saudi.
How much bigger can this be as a location for you and for other banks? I came here 30 years ago as a young banker. I came back 6 years ago as a journalist. And the transformation is phenomenal, and there's something palpable. This year, more than ever before, this year, something materially has changed. What is it that's changed the most for you, for the flow of talent in your bank to want to come here?
Well, I think lots and lots of change, and you've seen it firsthand over 30 years. But first of all, the role, the economic activity in the Gulf, obviously including Saudi, is outstanding. The flow of talent, capital, resources from east to west is outstanding, and going through Dubai, going through the UAE. The role that Dubai has staked out in DIFC in particular as a hub, not just for the Gulf, but also for Africa and beyond, and increasingly for South Asia, is very, very important. The extremely important connections between Dubai and the UAE and India. All of this makes this hub, and it is literally a hub, a very, very, very special place to be. And on top of that, it's a very nice place to live with good weather most of the time.
I can attest for that. 6 very good years. I don't know where we are on time because I don't have a clock, so I don't know whether you know where we are in terms of wrapping up. But Warren Buffett over the weekend, I mean, Dan and I obviously read the same news. We just write better stories. Warren Buffett, during the last 6 months or so, the incredible period for the US economy is coming to an end. That's a fairly damaging kind of proclamation by Buffett. How brutal is this recession going to be in the US?
Yeah, I think it's less a question. I'm not sure exactly what Mr. Buffett had in mind, but I think it's less a question of some sort of massive decline in the U.S. I think that's very, very unlikely. I think the U.S. has got an extremely strong economy right now with great job growth and is still a magnet for talent from around the world. But it's also got a high inflation problem and interest rates which are going to either stay high or maybe even go higher at some point. I agree with Jenny's view completely, until the economy slows down. Now, does that tip us into a big recession? I think unlikely. Could we have a period of negative growth? Yes. The Buffett's comment, I assume, is as much relative as absolute. Now, China, in the meantime, is going to grow 5 or probably more like 6% this year. The potential growth rate in China is probably more like 4 or 4.5% for years to come. When you get to ASEAN, which is, as a trading bloc, is the 4th largest economy in the world, is growing at a similar pace. And that will carry on for some time to come. So that the growth dynamic in the world is shifting from west to east. The US has an enormous lead, which it will not give up anytime soon. But the dynamism for global economic growth is clearly shifting to the east.
There was one comment that you made earlier which really made my ears click out, which is, as a CEO, you now need to think about the abstract possibility of 100% deposit outflow. How unprepared are financial markets for 5.5%, 6% to deliver the disinflation that is obviously needed to bring inflation down? Are you modeling, are you prepared for it? Do you sit around the desk and talk about 5.5%, 6%? What's your worst case scenario?
Well, worst case, I don't know. I mean, we're definitely focused on 5.25% for now and for a while. And it is having a slowing effect on the economy. We know that headline inflation is going to come down in any case because of subdued energy prices. And we're seeing a bit of moderation in wage growth, but it's still growing. So I think I do think we have a period of time where the markets are going to be in flux. The market specifically is saying, yeah, we're going to have rate cuts later this year and into next year. So the market has declared inflation pretty much.
Is the market wrong?
I think the market's a little bit wrong on that one. I think the market's a little bit wrong, yeah. I don't think we'll see, again, Jenny and I, it's almost like we rehearse this, but I definitely agree with her Fed view.
The gong is ringing. Maybe that's an indication for us to wrap up, pack up. It's been great to be with you, Bill. Thank you for joining us here in Dubai. And to everybody, have an excellent FinTech Summit. Excellencies, ladies and gentlemen, good morning.
Thank you.